So looking at fiscal policy, the idea of fiscal policy is basically to increase government spending or reduce taxes to try to increase the overall aggregate demand for goods and services, especially when there's a recession. The idea being if the consumers aren't buying things up, the businesses aren't buying up the resources, well, the government could buy up the resources, so you could increase government spending to increase the demand in the economy. So if the demand isn't created through the businesses or consumers, the government could create the demand in the economy and try to shift aggregate demand to the right. Cutting taxes, obviously consumers or businesses have more money in their pockets, then they can purchase more goods and services. Just one quick thing on an increase in government spending. Usually it would be a deficit spending, meaning the money would be borrowed to increase the government spending, because if you increase government spending but you paid for it by increasing taxes, the two effects would pretty much cancel each other out. So to try to have some type of stimulus, usually when it's an increase in government spending, the idea is you would borrow the money and then maybe have higher tax rates in the future when the economy was doing really well, or you could reduce government spending in the future to pay for the stimulus during the recession. So one thing about increasing government spending or cutting taxes is there's this idea of a multiplier effect. So it's pretty easy to see this. Basically, it's like skipping a stone across smooth water, that you have one, let's say, purchase leads to a bunch of other purchases in the economy, and it just keeps skipping along. So here in this case, the government purchases up $20 billion worth of planes from Boeing. That's $20 billion added to the GDP. Boeing will then buy materials, the workers will earn salaries, and they'll then continue to spend in the economy and continue to purchase additional goods and services. So this initial $20 billion of spending by the government will have more than $20 billion effect on the GDP. So you could see that, right? So if they spent $20 billion on planes, GDP would go up by $20 billion. The workers, let's say, earn an income because of that. They then buy additional products like meals or so forth, and then there's that skipping effect in the economy, creating more output. So you can see the multiplier effect. The idea is that this $20 billion will be multiplied through the economy.